Greetings, comrades. Our job here is to reconstruct 4 ledgers in order to calculate 4 mystery amounts. Importantly, we need to be mindful of our rules of double entry. So the first one we're going to do will be an asset account inventory. So anything that increases inventory is going to be a debit entry. Anything that decreases it will be a credit entry. We do need to be mindful of our cross-references. Our cross-references, even when we're reconstructing, need to refer to a ledger title. So therefore, we're not going to use words like purchases. There's no such ledger as purchases. Okay, so I think the best way to approach this is I'm going to number off all of my dot points, the items that will impact the inventory account, and then we'll replicate that for the others. So let's work our way down the list. The first thing we're going to enter is our opening balance, which I get from my balance sheet from the end of the previous period. So that's going to be item number 1. We read down. Then we get balances at the end of the year. So this is going to be my closing balance right here. I've got a dot point here about bad debts. That has no impact on inventory. Now, sales and sales returns will, but if we read down here, we've got a markup here of 150%. So therefore, in terms of the sales, our third entry will be the cost price effect on those sales. So we'll have a COS entry there. And ditto with returns, there's going to be a cost price effect of those returns. Discounts, allowances, they have no impact. Inventory loss, certainly, anything with the word inventory. So that's going to be entry number 5. The write down will be number 6. Drawings, we've got an inventory effect there. So there's the 7th one. Donation of inventory, there's another one. 8, discount will have no impact. And then number 9 is our mystery figure credit purchases. So we're going to have 9 entries here. So let's start things off in terms of reconstructing our ledger. So on the 1st of January, make sure you get in your dates. Our balance, according to number 1, is 7.5K. Now, in terms of the closing balance, that's going to go on the credit side, because what we're actually doing here is we're reconstructing a ledger by formally balancing it so that we can calculate our mystery figure. I'm going to put this on the 6th row. You'll see why later. At the end of the period, 31st of December, balance. And using the magic of Excel, we can work out what a 20% increase is. We just go 7.5K, and we're going to multiply that by itself, 1 point, whatever the increase is, as a decimal. So 20% is 0.2. So if I multiply 7.5K by 1.2, I get 90K, 9K. I think I messed up there with my decimals. Yes, I did. Alrighty, so that balance would get carried forward to the start of 2027. If we were formally balancing our ledger. Okay, so entry number 1 and 2 are done. Now let's go down to number 3. So sales, we don't record the sale price effect in terms of the inventory. That would go in the credit sales ledger. We're not worrying about that. So what we need here is to calculate the cost price effect of those sales using the markup percentage. So our other corresponding ledger affected by this is cost of sales, and we can use the magic of Excel to work out our figure. So we put in our sale price, 105K, and we're going to need to divide this by our markup, and we include the 1 here. So we go 1, which is the cost price, plus we convert the markup to a whole number. So 150% as a whole number is 1.5. We add that to the 1, which is our cost price. So we're going to divide this by 2.5. Gives you a 42K cost price effect. If we put 150% markup on that, we'd get 63K, and we'd add that back, and then that'd take us back to the sales amount. Number 4, the same approach. So we've had some returns. So now the inventory is coming back in due to our dissatisfied customers. So that's going to trigger a cost of sales entry on the debit side. So therefore, we're going to, again, type in our sales price figure, and we're going to multiply that by the markup plus 1. So 2.5. gives us $1,000 worth of returns. Point number 5, the inventory loss, 4% of the opening balance. We don't need to put in the date every time when we have entries on the same day. So again, there is an account called inventory loss that goes between our GP and adjusted GP. So to work out 4% of our opening balance, 7,500 times 0.04, careful with your decimals. Same with the write down. This time we're going 2%. So again, there is an account called inventory write down. It goes between our GP and adjusted GP. So this time we're going to go 7,500 times 0.02, 150. Okay, we're up to point number 7. So drawings, be careful with these fractions. Often students get the wrong way around. They'll put in the cash figure rather than the inventory. So we just take 2/3 of 3,000. 1/3 would be 1,000. 2/3 is going to be 2,000. So this is going to be a $2,000 credit because it's reducing our inventory. And we just cross-reference that with drawings. And then donation. There's no such account as donations. So we're going to cross-reference this with advertising. This is promoting our business through a bit of PR. And so therefore we've got advertising of 1,500 for point number 8. Oops, what happened there? Okay. All right, now we're in a position to calculate our mystery figure. So what we're going to do is we're going to sum up all of those credits. And we're going to put a matching total on the debit side for 54,950. And then we need to work backwards to work out our mystery figure. So therefore, what we're trying to calculate here is credit purchases, as it says in the question. There's no such ledger as credit purchases. So this will, the other account affected is accounts payable. Okay, so we just simply go equals our 54,950 minus our 2 debit entries. And we get our final figure, 46,450. Now, part 2. We've got to reconstruct the AP ledger to work out our payments to our accounts payable. So let's go with the same process. So the first thing is we're going to use our opening balance. That's going to be our first entry. Second entry will be our closing balance, number 2. Again, we work our way down the list, and what we're trying to spot is any of those bullet points that will impact AP. Not a bad debt, sales, returns, etc., no impact. Same with inventory losses, write-downs, etc. But certainly the discount revenue, which is right down the bottom here for point, that's going to be our third one. And then the fourth one, which is kind of hidden here, is what we just worked out. We just worked out our credit purchases. So this is going to have implications for our accounts payable ledger. So our fifth and final one will be our mystery figure. So we're going to have 5 entries here. Now, just remember that this time we're dealing with a liability. So therefore, anything that increases our accounts payable will be a credit entry. Anything that decreases it will be a debit entry. So let's start on the credit side with our opening balance, which we get from our balance sheet. We've got 5,000. Then I'm going to repeat what I did with the inventory one. At the end of the year, I'm going to put this down to row 3. Our balance at the end is 10% lower. So therefore, I can just go 5,000, my opening balance, and I can just multiply that by 0.9. Or I could work out 10% of 5,000 and deduct that, and we're going to get the same answer. And then I would carry that forward to the start of 2027 if we were formally balancing our ledger. Okay, so we go all the way down the bottom there to the discount. So discount for prompt payment, that actually reduces what we pay. That's the whole point. We're trying to basically reduce our outflows and generate some other revenue. So therefore, we do a debit entry, a reduction of the liability, discount, revenue. Again, there's no such ledger as discount on credit purchases. So we've got to identify the ledger here. So that's a $200 entry. Now, entry number 4, we need to be a bit careful with this one mathematically. So this is going to, we've purchased inventory on credit. So therefore, that's created a liability. But there's some GST attached to the inventory. So what we need to factor in here is the fact that we've bought some inventory on credit, and we're also going to be charged some GST. So therefore, in order to calculate the amount, we're simply going to take that inventory purchase credit that I've got in yellow there, 46,450, and then we're going to multiply it by 1.1. Multiply it by 1. So we've got the value of the inventory, and the 0.1, it represents our 10% GST. So now we're in a position to work out number 5, our mystery figure, and so there's no such ledger as cash payments. So what we want here is our cash at bank. So what we need to do now is we're going to total up our credits. So again, using the magic of Excel, let's just go add these two together. We've got 56,095, so then we mirror that on the other side. That's what reconstructing a ledger requires. Matching totals on both sides, and then we just work backwards. Take the 56,095 and then subtract your two debit entries. And what do we end up with? 51,395.